Hello guys, in this video I will explain you what elements must be taken into account if you move your fiscal residence in Italy while you left behind a property in your country of origin. But the same applies also if you want to invest in real estate in a third country. Whether this property is under rent or not, there are taxes to be paid on it and are so high that could reduce quite a lot the convenience of this investment or of this relocation. The purpose of this video is to help you to understand what you are going to face in Italy and try to simulate how much taxes you will have to pay. I just want you to remember that this video has an information purpose. In addition, I'm not a certified accountant, but just a person who has the passion of tax planning for individuals who wish to relocate in a different country. And in this case, we're talking about Italy. Having said that, let's get started. This time, I will start, unfortunately, with the bad news. As Italian fiscal resident, Italy obliges you, unfortunately, to pay a property tax on your foreign property. Yeah. This tax is called EVA, and this is something like the IMU applied for foreign assets. The calculation works like this. First, you need to understand how to assign to your property a value which is recognizable for the Italian tax authority. Normally, for this measure of EU or Schengen area countries, the cadastral value is the one taken into account for the calculation, of course. For some other countries instead, we will need to check the purchase costs of the average market value. For each of those countries, Italy has premerged rules and criteria well defined, and you will put them in I will put them in the description below the video, along with other resources on this subject. So, once you have learned the procedure to calculate the correct value, then you can proceed with the following steps. Once you get the value of your foreign property, you multiply this value for 0.76%. After that, you subtract the EVA to the eventual property tax of the country where the assets is located. If the value is different from zero, then this amount has to be paid to Italian state. This is the methodology called tax credit, and it has been put in place to avoid paying the property tax twice, in the country where the asset is located and the country where you have a fiscal resident. But I have a very small good news here. If the foreign property has a value of only 26,000 euro, the EVA is not due. Okay, so let's just check an example with the numbers of EVA. A property in Spain. Let's consider a property in Spain with a cadastral value of 140,000 euro. And in Spain, the property tax is called EB. And this is what I have to pay to Spain, to Spanish state, if I own a property in Spain. But since I'm fiscal resident in Italy, I have to take into account this cadastral value, which is the value for the agreement between Italy and Spain for the calculation of EVA. I multiply this for 0.76% and I have to pay in Italy 1,064 euro as EVA. Now, based on the rule, based on the law, if this is bigger than 200 euro, in this case, yes, of course, then EVA has to be paid. But how? Subtracting the EVA with the EB. So, since the EB is 778 euro, we subtract this value and we have to pay to Italy 286 euro. There are certain cases where the foreign property tax is higher than EVA, and then to Italy you don't have to pay any difference, you have to give any money back. Or the case where the calculation of EVA is like 200 euro or less for a value of 26,000 euro property. Here I have a couple of considerations to make. When you deal with EVA and you think to pay too much taxes because of the property that you own abroad and you think that is not fair, well, there are some kind of optimization that you can try to think about. So we know that the EVA we set at 26,000 euro is the value that allows you not to pay it. So you might think to split the property in smaller property, which one of those with a value of 26,000 euro, and you don't pay the EVA in all of your foreign properties. The other case is to split up the property with other shareholders, like an investment abroad that you do with other person, and each one of you will own just 26,000 euro of value of this property, and then you might be exempt. I know it's quite tricky, but it's the only thing and the only optimization that comes in my mind. Instead, what about if I put under rent the foreign property? Here we have to follow the principle of the worldwide taxation, which is applied to individuals which are fiscal resident in Italy. As many countries in the world, Italy taxes you on all the income generated abroad, and of course, your foreign rental income is part of it. More in details, here's how it works. If the foreign rental income is taxable in the country of origin, then you have to report the gross amount, not the net, in the Italian tax field return. Calculate and pay the Italian taxes on the overall amount, but you will subtract the taxes that you have already paid on rental income in the country where the property is located. And this means applying the so-called tax credit method on the rental income. If the foreign rental income is not taxable or not imposable at all in the country of origin, then you have to report as well in the Italian tax file return, but reduced with a forfeit deduction of 5%. So the gross amount reduced. I have also a consideration to make for the RPF taxation. It's worth to have this investment while you're fiscal resident in Italy? Well, I would say it's worth only in two specific cases. If you in Italy have a forfeit regime, you're a freelancer with forfeit regime, you are subject with a parallel separate taxation. So your RPF taxation is start from the lower boundary. In this case, your foreign income, your foreign rental income is gonna fill up this RPF, and you have this 23% as a minimum. It starts to be tolerated, okay? Of course, you have to add the communal tax and the regional tax. So you're gonna pay something like 25% unless you have other deduction or detraction to squeeze down your taxes. The second situation is when you want to move to Italy, you bought a property in Italy, but you left behind your property in your country of origin and you're living out of the rent. But this rent will be highly taxed in Italy. So how do? You can buy a property in Italy, you renovate this property, and then you have all the massive deduction of 110%, 80%, 90% of renovation, remodeling, facade or solar panel or new furnitures. So you might have a really big amount of money to reduce your taxes each year for like 10 years. This could be another trick. So you reduce with Italian foreign property your foreign rental income, and then you won't be subject at 23% to RPF, but you will be subject on a lower band rate because you reduce your calculated amount of tax to pay. Of course, having a property abroad while fiscal resident in Italy is not convenient for those who have already a big RPF taxation in Italy, a domestic one. So your band rate would be already 38% or 43%, and then this is the band rate that will be applied for your foreign rental income. This problem is coming out because there is no difference, because we cannot apply the cedolare secca for foreign incomes, but only for the domestic rental income. Thanks for watching the video. I hope this has been helpful for you. If you have any question, just drop me an email at ESENtaxa@gmail.com. In the description below of this video, I will put some reference from which I took this information, especially from the Italian tax agency. And please visit my blog, www.esentaxa.com, if you're interested in international fiscal matter. But if you want to be updated on Italian fiscal matter for free, just subscribe to the channel. Thank you very much. See you next time.